All right, the wait is over. We're going to have a roundtable discussion with some of our traders from the trading desk here. That means blue chip trader, scalp trader, event trader, and chart trader. Sorry we couldn't get everybody in all at once, but considering we have four of the great briefing minds on, I figure we'll get some good stuff out of this interview. And basically what we wanted to do was to give everyone an introduction, or at least a reintroduction to our traders, understand their style and approach, and get a sense of what they think of the markets and what may be shaping up in the days and months ahead. So the first thing we're going to do here is introduce what I'll call the captain of the trading team here, and that is Scalp Trader Damon. How are you this morning?
Hey, I'm doing well, Jim. How about yourself?
Oh, I'm doing quite well. Excited to get this roundtable discussion rolling. So one of the things I wanted to do for the listeners is to have everyone give their a small background story of their trading style, their approach to the market. Now, I do want to preface this and say that let's keep it as Cliff Notes version as possible, because we do have four of us on here, and we could go on all day if we really wanted to. So just give the listeners your overall background, some of the markets you look for, some of the things you look for, and then we'll jump in off of that.
So I've been trading since around 1997, so a little bit over 20 years, and I started out initially as a short-term trader, basically intraday, never really holding positions overnight, and I traded that style probably for about 10 years, and I kind of evolved during the financial crisis, and during that period of time, just seeing so many stocks just trading at such distressed levels, and starting to see that the fundamental stories actually could come into play, and that if you could accumulate some of these things over a period of time and wait out for them to rebound, that you could actually put up pretty decent gains. So that actually kind of awakened me to the opportunity to trade on a swing basis, and understanding that the fundamentals could have a real play a real story in terms of your overall gains and opportunity. And so since then, I've added several strategies, and those include both yield strategy, swing trading strategy, a distress strategy, and momentum strategy, and I still do the scalping as well. But one of the things I've noticed is that there's always something working in the market, right? So if you do your work up front and have the patience to kind of sit back and wait for opportunities to arise, you will always be able to find something that's working. So it's really important I think, to have kind of a multi-strategy approach to the markets, and then you're not just sitting there kind of waiting for, maybe trading against a bad market because your one strategy that it worked last year or 6 months ago is no longer working.
Yeah, it's definitely important to understand how trading needs to evolve from a personal trading standpoint, and it sounds like you've really progressed from just being that quote-unquote scalp trader in your early days to being more of maybe a longer term implementing strategies, would you say?
Yeah, well, I mean, I think there are periods of time when the VIX is higher that scalping is the key way to go. Intraday, you'll see plenty of opportunity, and we've seen that in recent weeks up until probably the past week or so. I'd say the past 3 or 4 weeks up until the past week had been extremely active. So, yeah, I think that just essentially having kind of that multi-strategy approach just allows you to take advantage of wherever there is opportunity. And sometimes, like right now, there's just not a whole lot going on the scalp side. But I did get we have a couple yield positions on in the portfolio. We got dividend distributions over the past week that make up for many days or weeks worth of scalping. So even though I don't have a lot of trades on right now, money is working for us right now, just through putting on income producing positions at the right price that have both not only accumulated capital appreciation but also generating really strong yield.
Yeah, and let's not forget that you were no stranger to the crypto markets back, about a year and a half year ago when they were flying all over the place. So you took your personal strategies and applied it to even the crypto market.
Yeah, so actually the crypto market was pretty interesting. It reminded me of trading in the in the late 90s, during that period where you knew that you were trading against a lot of non-professionals, a lot of people who were just novices, and the crypto market was that way in 2018 for basically all of 2018. Then the institutions came in and made it a lot more efficient, so it became much more difficult to generate profits there. But for most of the year, it was really pretty spectacular. 2017, and the beginning of 2018.
All right, let's bring in event trader Gavin McGuire, and your name suggests, with the event trader moniker, that you tend to look for specific catalysts, but that's not always the case. So why don't you give us a little background about Gavin McGuire, the trader?
Yeah, it was probably a lot more event-focused when I first started. I've been a briefing for 15 years now. I started trading in 2003. And at the time, I'd be trading around events. So obviously, with the financial crisis and everything going on, there was a lot of things that you could trade around, such as votes within the Senate for backing the banks, things along those lines. But since then, I've evolved a little bit. I'll still trade events, and most notably, I would say that those events would probably be based around earnings more than anything. As anybody that follows me knows, I do that end of day earnings commentary and the beginning of day earnings commentary with a big focus on what was coming out, and so I'll still trade around those. But for the most part, I'm a bit of a hybrid trader, I would say, because I trade both the macro and the micro. I'm just looking for opportunities. A lot of the macro will be more day trading setups in the futures that I'm looking at, but I'll also be looking at macro themes for swing trades, such as the 5G that we started getting into at the beginning of last year. We've had some nice success there, and I'll just kind of build off those themes and provide color around that. But I really like finding those beaten down fundamental names that are going to come back too. So I'll always be on the search for some value plays that are out there, and just kind of really looking for opportunity, and whatever shape or size it comes in, I'm okay with that. So given my role here and just kind of following along the day-to-day operations, gives me the ability to track a lot of different things. That's why you'll see me kind of really jump around in different areas a lot of the time. But for the most part, the names that I like would be, for instance, like this Lamb Research. I had earnings yesterday, just a beaten down name that has a potential catalyst to really take it out from that bottoming pattern that we've been seeing, things along those lines. Trying to think of some other names. AVGO is another recent one that I had gotten in that was just kind of bottoming out from selling off post earnings a couple of weeks, and then really finding that fundamental story changing. So really, I'm jumping around all over the place looking for opportunities and keeping an eye on the things that I know best, such as banks and solars that I've been following for the longest. So that's basically this my background for trading and what I'm looking at on a daily basis.
All right, and you do have a pretty good mix of both futures and individual stocks and different portfolios. You mix in a nice mix of day trading, swing trading, and then some individual plays that you're going to hold for years to come. So, and you do a really good job of keeping updated your own personal portfolio, and you circle back quite a bit as well. And so, definitely wanted to make sure that the listeners were well aware that you're very broad based in your overall coverage. So
yeah, and also on top of that, Jim, for anybody looking, if you do a search under focus FOCUS for any newcomers that we have out there. That's where you can track down the portfolios for the traders and get the full list of positions that we're holding and discussing.
All right, so the next trader we're going to introduce is Blue Chip Trader, and he doesn't do a whole lot in the realm of futures, but he's no stranger to trading ETFs, be it the IWM or the diamonds, triple Qs. He'll put on various shorts as hedges and whatnot, but he does focus a lot more on specific names, and he's a swing trader at heart, so I'm going to give him an opportunity to discuss his background and approach. Go ahead, Blue Chip.
Great, thanks, Jim. So I have a little bit different background from everybody else. I did start in the late 90s, and I had the blessing to start off with some of those big market-making firms down on Wall Street, and I had the opportunity to trade alongside some market makers and specialists as a clerk on the Florida Stock Exchange, the New York Stock Exchange, the Amex. Traded some options, traded a little bit of futures, helped them out there, but mostly with the advent of ETFs as well. And then when the NASDAQ market took off in the late 90s, 2000, I was assisting market makers there on that side of the exchanges. After about 5 years or so, and just watching the market and learning and absorbing as much as possible, I started to really fall in love with technical analysis, because I realized that fundamentals are great. They tell a story. They tell you why stocks are moving or which ones you should be focusing on. But it's really came down to the supply and demand of price action that made you actual money. I was more curious to know why stocks were holding certain levels or why they were getting rejected at certain levels, why they would break through, why they would run significantly higher. So I really kind of plunged into the technical analysis side throughout those 5 years, and that's really where I sit right now. So here I am about 20 years later, and I do consider myself somewhat of a hybrid swing trader, meaning that I do start day trades, but given my background, I tend to trade everything fairly small with half-size positions, and I kind of scale into and scale out. And if a trade is not going my way during the day and it's coming down towards my risk parameters, I tend to scale back on them, or I tend to just exit the trade because I don't feel comfortable holding that losing position overnight. I like to be proven right quite quickly after I take an entry in a trade. And even when I am proven right and stock does move in my favor, I will peel something back just as quick, even if it's an intraday time frame, just to reduce my risk and to just sleep better at night. And then that remaining balance I'll try to keep on as a swing trade for multiple days or weeks, however it goes along. So I'm kind of this hybrid mix. And of course it all depends on the volatility of a stock and how I feel about the action in the overall market. But over the years, here briefing, I mean, some of the main focuses I've been working on has been sector rotations, as well as focusing on leaders in the market. And from the swing trading column to the technical take that we post every morning, I'm always identifying the intermarket relationships, as well as the relative strength and relative weakness in sectors. And then from there, I typically will make a lot of my swing trades from that perspective. And then one of the go-to lists that I go to all the time is the liquid momentum focus list, and that was a proprietary list we came up with about 10 years ago of finding the top most liquid leaders in the market, and on a relative basis. And those have proven to be just fantastic swing trading, even day trading, leading names in the market that inherently have this underlying bullish bias because of the nature of what the scan is searching for. And you can see, like for today, Xilinx is a great example. Xilinx has been sitting on top of the focus list for about 2 to 3 weeks now, based upon the solid relative strength over the last 3 months, and it just blows out, gets a big breakout in response to earnings today. So just one of those, just not too surprising given the fact that it's just been holding up as a leader throughout all this time. And then the final part of technical analysis is I do have my own little proprietary scans that I came up with over the years that I just like to kind of focus on, and yet those are always found on the TA page scans, and they're just basic. They're basically a computer-generated scan. It's not a system by any means, but it narrows my search down each morning when I'm looking for an opportunity. If I'm bullish or bearish, I can easily just go to the pullback long candidates and say, okay, the market's poised to go higher this morning, and what's on the pullback long radar today. First Solar was a perfect example of one of the names I was here today. There was also another energy stock, I believe it was CXO. CXO is trading up about $2. First Solar traded up out of yesterday's high for about a 2-point gain. Netflix was on my radar as well. That's pulled back in the last 3 or 4 sessions, and that was trading up about $8 in an early trade. So it's always, those scans are just kind of these, if I'm looking for ideas and looking for themes, I kind of just try to look and see what, put all these signals together and try to find one of these better low-risk opportunities. Ideally, I'm not just looking for the day trade, I'm looking for that multi-day swing in context of a trend.
All right, and just for those who are following along at their office or whatnot, and those who might be listening to this on a replay, some of the things that Blue Chip was just talking about, where he finds his kind of go-to areas on the in-play page. I'll walk you through it really quickly here. When you are on the in-play page and you go to the Investing and Trading tab, scroll down to Technical Analysis, and I'll just click the Liquid Momentum one for you because that was the one that he referenced, where you'll get a list of individual stocks. I think there's 50 of them on there, and are they ranked in order? So is Microsoft?
Yes.
Okay, so the one that you would look to first, if you're scanning your particular stocks that you're going to look at for idea generation, you're going to go through Microsoft, Boeing, Visa, and whatnot.
Yeah, it's not the most original name for the focus list, but it is exactly what it states. So liquid being liquidity. Obviously, Microsoft is one of the thicker names amongst these leadership names, followed by Boeing and Visa. And then the second portion of that would be momentum. And then that is where we do a weighted relative performance over 1 month, 3 month, and 6 month.
All right, so the next one up is Chart Trader, and you have a unique perspective because you focus generally on the futures markets. Now you do dabble in some individual equity names and sectors for the most part, and I know you gave a pretty big introduction to yourself yesterday when we had you on, so I do want to refer the listeners back to our conversation yesterday that I had with Chart Trader, but I guess my question coming out of that is your focus more on futures as opposed to individual stocks. What was the genesis of that? Why do you find that to be your edge?
Okay, so I did trade individual stocks. In fact, mostly individual stocks if you go back as far as, say, 2004 to 2006 or 2007. And really the global financial crisis period, the big crash, that had me focusing more on the indices, and I'd already dabbled in fixed income and commodity markets and in currency markets ahead of that. So I was kind of primed to move to a more top-down strategy, and I suppose that it just works for me. I think that I really do believe that it's almost like right-handedness and left-handedness. I think that people find out whether or not they prefer a top-down perspective or a bottom-up perspective, and I imagine it has just a lot to do with some deep personality variables. I think it's more comfortable for me to think of the world as a big jigsaw puzzle and to want to have the really big picture view as the main thing that I'm looking at. I like to zoom out as much as possible and get a tremendous amount of perspective. But the other advantage that I've found with a top-down perspective is you can get data points on larger asset class markets that you can't get on individual stocks. And one of the most important sides of analysis for me is sentiment data analysis. And you really can't get sentiment data on a single stock, not in anything that really It really matters. I mean, obviously, some stocks are just extremely correlated with the indices, and so you can trade, very, very large cap equities almost as if they're index stocks. But there's, of course, always individual company news that can come through and change the picture for that one stock in a way that the picture for the index isn't changed. And I really like to have available things like highly interesting options data analysis, futures trading, positioning analysis, surveys. So you can actually just get surveys about what people believe the market's going to do, which gives you some insight into how they're prepared and how they're positioned. And having that extra input, otherwise all you're doing is looking at price and volume through time, and then the same facts that everybody else sees in the headlines, and there's no extra edge. You really just have to go on the same information that everybody else is looking at. But I find that most people who are involved in markets don't focus that much on sentiment data, which is why I believe it's a source of genuine edge. When you focus a lot on a data point that has validity in terms of its impact in analysis that not that many people are focusing on, I think that's a source of direct edge. And the only way that you can really apply that is by focusing on top-down strategies. So that's probably the main reason.
All right, I'm going to pause right there with you. I'm going to get you back in just a second here, but look at this. We got a real-time trade from Scalp Trader right on. He is buying Goose, Canada Goose. You want to talk about this one? Scalp Trader?
Oh, sure. So yeah, it was downgraded earlier today by Wells Fargo on valuation call, and just looking for, it's down about 10%, big momentum name, relatively thin in terms of the float. It's about a 58 million share float, 18% short interest. A lot of times, you get an initial shakeout when an analyst comes out and hits a stock with a downgrade, but then you get that kind of late day rebound, especially in a name that has relatively thin float and big short interest. So just looking to play a snapback here. Nothing super compelling, just looking for, 1.5, 2 points on a bounce.
All right, so since we've gotten the formal introductions out of the way, I want to attack where you guys think the overall tone of the market is. We've seen a VIX now flirting around with that 20 area, which is conducive to, I know, chart trader strategy. And I'll get back to you right now, Brett. You highlight the VIX around 20 quite a bit, and you find quite a bit of opportunity trading the indices, the futures markets in particular, in this environment. So do you see any slowing of that pace with the VIX around 20?
Slowing of the pace of the building of volatility?
Slowing of the pace of your particular trading.
Well, again, we're in the sort of the early half of earnings season, and my pace slows down during that period because there's a lot of different levels. I consider it to be a multi-level tape, right? So when you have something like we had at the end of December, you have a really kind of I described it in a previous piece we did as looking at a chess game. Right, and you're trying to figure out which side is going to win based on the position of the pieces. But what if you found out that the picture of that chess game was actually a number of different chess games superimposed through transparency slides, one on top of the other? That's how the tape changes when you're actually looking at the order flow coming through during the first half of earnings season, because you have people who are repositioning where they don't have a lot of turnover in portfolios, but they do in reaction and in anticipation to earnings. And so you've got committee meetings, people make big decisions, and they move large tranches of capital around in bottom-up plays. And so the tape for an index-level analysis actually becomes really muddled by this sort of multi-level competition of different strategies. But when you get past roughly about the first 2 weeks of earnings season, you get more back into a situation where you have market dynamics, and people are actually on the same playing board and playing the same chess game. So your analysis of patterns intraday, your analysis of patterns on the 60-minute charts, your analysis of order flow, if you watch just the orders coming through, all of it is going to start to make sense more when you're trying to determine what sort of game is being played and which side is going to win at any given moment. So I find it's just a little more muddled during the first half of earnings season. I tend to slow down a bit. And as we saw right now, I'm watching this tape, and I feel like everything is bottom up. I mean, everything. Just the way the patterns are going through. So we had that short on earlier, got about 30 points of the money in the NASDAQ short. And the way that the market came back, I mean, obviously we put tails on both sides of the pattern. So we're sitting here back kind of in the middle of the intraday range after shaking out people on one side of the market, shaking out people on the other side of the market. We're gelling back to the middle. But just the way that the market came back, the way that it broke the level, we hit some stops. Obviously, those are index level stops. We flushed things out, but the way the market kind of crept back, just watching the orders go through, I feel like I was just watching this bottom-up game where the indexes are really just the average of a number of different individual actions being taken in individual equities rather than big and important changes that are happening to the market as a whole. And it just makes it very difficult, and you know, it's not, I like to take risk, to put risk on the table when risk really represents the best possible opportunity. So, you know, I'm kind of going back to sitting back and waiting to start to see the sort of dynamics that I feel like I have an easy time taking advantage of. But as far as the larger pattern, I mentioned a few days ago that we had a wedge in the S&P, which basically is a narrowing scope to the highs and lows in a directional move. So as we moved upward, the breakouts were becoming less aggressive, the down moves were becoming less deep, and we started to narrow and narrow and narrow. And in my experience, generally the way that evolves is you get to a point where you blow out the top line of the wedge, and then you blow out the bottom line of the wedge. We've already accomplished both of those tasks. We haven't gotten too deep into it, and now we're just kind of in a consolidative period, and I think you just need to let it evolve a little bit. I think there's a lot of things that are really going to start to show up as an opportunity as we kind of build out this pattern more. We're putting levels in place. We're rejecting both sides of this sideways consolidation right now, but that is building up a kind of resource. So when you reject that, it starts to look definitive to one side or the other. If you've got people who are really bent on getting long this market, they see the rejection at the lows today. Since we broke through, since we flushed it out, and then we move back to the middle of the pattern, the lows that we have today now, right around, for instance, in the NASDAQ, I think it was around 66, 63 or so, that becomes a really important low because there's more conviction for people who've just gotten long this market because it held. So there's kind of a proof-disproof series as you go through these processes of building a lateral consolidation. So the lows and highs become more and more and more consequential. And eventually, everything comes to a head, and you break decisively one way or the other. And I don't want to get ahead of myself as far as deciding which way that's going to be right now. I'd rather just watch and analyze and get a sense of where the pattern feels like it wants to go, rather than try to place on it a set of assumptions about where it's going to go. I don't really know which way it's going to break, and I want to get a sense of that as it builds itself out. But I think that we're gradually building this thing to a head. With the VIX at 19, probably the reaction one side or the other when we do firmly make a directional decision is going to be probably a pretty good opportunity. So I'm letting it build out.
All right, I'm going to bring Event Trader back in and talk to both of you guys on this one, because coming into the day, you both had, for lack of a better term, a short bias. You both put on short trades and were both eventually stopped out of them. And I know you took some profit early on in your, actually both of you guys took profit on your first unit of that one. Now that you've put the trade on and you've been stopped out, does that give you any new evidence that maybe the bulls might be in control of this? Does it change your dynamics of how you're coming into thinking about the market? Does that apply information for your next decision?
I'll take it first, Brett, and then you could jump in. I mean, for me, it hasn't changed anything yet. I don't think we've had kind of that knockout blow that Brett was just talking about there. You know, there was a few items that was sticking out to me that had me looking to lean on the short side, considering, number one, we're going up against the technical resistance. The semiconductors, I was definitely a little surprised at how strong of a response that we were getting from them. I mean, the reports were decent. The guidance was, in some cases, okay. But some of the comments that I saw about the longer-term fundamentals facing it with the inventory and the lack of a bounce back into memory space in the second half of 19, I thought that was going to be key. So I thought we'd roll over on that. And then Of course, there's the PMI numbers that came out. So there, and Wilbur Ross's comment as well on trades. So there's still a lot of fundamental unknowns that are facing the market. You continue to see a response to these earnings, though, of willing to buy. We saw it start off with Apple when they had their warning back on January 2nd. We saw it creep into the financials. Now we're seeing it play out in the semis. Some of those industrials, too, have been seeing decent responses to earnings. And I think a lot of it has to do with positive commentary around January that we also saw in today's U.S. PMI number. Really upbeat comments when I went back and looked at the manufacturing and the quotes from people saying that the shutdown wasn't really impacting them at all or anything like that yet. So I think right now we have a short-term bias that's certainly bullish, but for me, I still don't see enough to get me buying in on that next level at the moment. I'd like to see a little bit more confirmation on either the buying pattern or at least the fundamental data, particularly some of the bigger issues facing the markets like trade, Brexit, and everything like that get settled. Until then, I have a tough time jumping in aggressively long until we get some of those bigger issues settled. So I just continue to see ourselves trading in a range where I'm looking to be a little bit more active shorting and hedging against the upside, and then when we come down to the low side, looking to add to the portfolio, looking for those buys. So that's kind of how I'm looking at it right now, and today for me I just thought was setting up for a short.
And for you, Brett, you came in with a similar type of outlook where you were looking for, you previewed it on the page, you were looking for that 66.95 area, didn't quite get there, but you did jump in on a short. Has anything changed? Are you looking for maybe another pop or completely sitting on your hands?
So the reason why I shorted when I did, we built out a process in the NASDAQ. Obviously, the NASDAQ was slightly outperforming the Dow and the S&P, and I kind of compare those three. And I generally don't like to short the relative strength, but in this case, it was so clear that the relative strength was driven by the kind of knee-jerk reaction to positive earnings from semiconductor space. But if you look at the NASDAQ throughout the day, including slightly before the open and pre-market, you've got this kind of move along 66.75. Let's say, right? We got about 5 different lows within a point or two of that. And that last one, we had broken out above the highs of the morning range, failed, came back down, stabbed down into that low. It's just a very simple setup to me. I felt extremely confident that I would at least get something on that short. If you make that kind of widening, expanding triangle kind of pattern where there is a consistent low across 4 or 5 different touches, then you break above the range, then you come back down and smack into that same level again, it's a really consistent strategy to just short when you get about halfway back up that range. So that's where that 66.90 to 66.95 area was just, there's no way the market's not going to at least retest 66.75. And probably when it does, you're probably going to flush out stops. Now, we got the cheapo version of that. We flushed the stops and we didn't get anything else. We just ended up right back in the middle of the range. So I felt like it was more or less a guaranteed result to get that move to check down to the level again. It's got to prove the level at that point, right? Because you've already disproven the other side. You've disproven the top side of the pattern. You're going to shake people out with stops under that level. And the question is, did we really get follow through? I actually thought we would. I'm surprised that I didn't at least get 66.50. Or 66.52 on that trade, and back to kind of touch the overnight lows area and test that zone. I'm really surprised actually where it held, but I felt extremely confident that we would move back down and at least check through 66.75. I think that was pretty inevitable. And you know, it's a simple setup if you guys want to just kind of think in these terms. When you see a level tested several times, and then it's part of a range, you blow out the other side, you shake people out, you move back down, and you test that level again. Just go ahead and look for a bounce back roughly around the mid-range of that range, and get short. You can leave a stop. You know, taking a reasonable risk, your stop is going to be up just inside of the top of that range, and you're going to be able to get out ahead of a run of stops above it. and you'll generally get something on that type of setup. So that's really why I got in the position that I got in.
Hey, Brett, out of curiosity, it's Gavin here. Do you got any preference in the instruments you're using to be either long or short? Meaning, do you have a preference of shorting the NQs and going long the S&P? Or are you looking at any of the constituents in there for segments that are stronger than the other?
Yeah, I prefer shorting the NQs right now. And one of the main reasons why is the banks were completely washed out. And I think they were washed out on recession fears, and I think we're starting to see data that suggests that was jumping the gun. And basically, if you take the Nasdaq is pretty much the S&P if you subtract out energy and finance. Right. So I don't want to be shorting energy and finance right now, because at the same time we were also getting seeing crude oil just destroyed for the same reasons that the banks were. So I think that those were washed out more. They were more capitulated out, and so I just kind of feel like there's more loose retail money hanging out in some of the tech stocks that can still get washed out. When we have doubts about the cycle now, there's likely to be more of a reaction to the downside in the tech stocks. But again, earnings season changes things step by step. Like every day you get new information and that picture changes. But right now my instinct is to look for the shakeouts to be a little deeper at times in the NQs. And we'll see how that plays out, but that's been my bias.
All right, I got a quick question for Scott, too. Scott, what's your thoughts on some of these semi plays here? I know we talked a lot about the earnings. I don't think we've had a chance to circle around, but we always have the talk about price action versus fundamentals. I noted some of the fundamentals were decent for the semis here. Some of the longer term outlooks were a little concerning, I thought, but obviously the price action is confirming some sort of bullish sentiment. So I was just curious at how you're looking at this move in the SMH. I know we both like Xilinx and Lam Research, but are there any other ones that are kind of sticking out to you from those reporters?
Right, so let's take a bigger picture view of the semiconductor space. If we look at a long-term monthly chart of the SMH, or weekly time frame, the sector had an absolutely stellar 2016 and 2017 price action. They were just basically grinding higher and higher and higher for 2 years, right up until 2018. Fast forward to that February of last year, the market took that big hit that kind of took the wind out of the sails out of a lot of different stocks in the market. Semiconductors did actually edge a little higher, and they peaked out in March of 2018. That's the SMH. Then thereon, the market basically went sideways for semiconductors throughout the spring into the summer, and then they started breaking down more aggressively around September and October, and really kind of underperformed everything and paced the way lower in Q4. Now, if we look at that bigger picture time frame, if I go off the 2016 lows, or 2015 lows, and the peak of 2018, we actually retraced approximately 50% of the move in the SMH, which brought it right down to that $80 level in late December. So we're getting a nice little bounce back off the 50% retracement of what looks like to be a 3-year rally, so to speak. I definitely think that semiconductors as a whole are under-owned. Over the last couple of months, a lot of aggressive distribution has gone on, as we've mentioned before, in a lot of these names. But I think now they are under-owned, and I think given the extremes that we saw in Q4, a lot of these stocks are now making a good recovery effort. These few earnings responses are extremely bullish, and I think that, like you said earlier, you're surprised at how bullish they are. And when I hear you say that, again, I'm not really much of a fundamental person. I just listen to everybody else talk about them because that's the story that I have to put into my mind. But the actual numbers and data itself, I rarely pay close attention to. I always want to hear the response of the people who are smarter than me, tell me what's going on. So when you tell me you're surprised about the response to the semiconductors earnings when you didn't think they were all that great, that tells me that this is an extremely under-owned sector right now, and I'm seeing really strong breakouts, lots of upside potential in names for weeks to come, and I'm turning quite bullish on the group right now. Now, short-term intraday, am I going to be buying Xilinx up $17 at an all-time new high? Hell no. I'm not going to do it with anybody's money. But is it on my radar? Yes. Is it going to pull back and I'm going to monitor it? Yes. Are there better looking charts out there? Yeah, I think something like an Advanced Micro Devices, AMD, has really yet to break out of that January range that it has. It's got earnings coming up here in about 4 or 5 sessions end of January. Maybe we get a little bit of a breakout in AMD over $21 to capitalize on a pre-earnings swing. Something like Micron. We all know Micron is like one of the cheapest semiconductor stocks out there based upon the accounting ratios. Granted, there's industry issues along with like WDC and other storage-related semiconductor plays, but looking at this chart, it does look like this multi-month downtrend from Micron could be turning a corner here, and maybe there's this short-term swing potential to the upside. There's just so many different names that I can go after here. AMAT looks great, trying to break out a little bit. Texas Instruments, solid report, solid response to earnings report. So there is, to me, this, I wouldn't even call it a FOMO trade, fear of missing out. I would say this is just definitely an under-owned space that I am really trying to pay a lot closer attention to as we move a little bit further through earnings season here.
I know you don't like usually doing it ahead of earnings, but any thoughts of owning WDC ahead of tonight's print?
Hell no. You know me. I can't do earnings. It's a 50-50.
I knew the answer. I just figured I'd ask because I know that's probably going to be one on.
If you give me the money, I'll take your money and I'll bet on it.
Hey guys, mind if I jump in here?
Yeah.
Yeah, so yeah, that was an interesting conversation about semiconductors and kind of the short-term opportunity. It puts me to sleep because that's not what I do. I just want to kind of really express like the differences in our style. So like in terms of say a semiconductor or any technology name for me, you know, I'm looking for things that are a little bit off the radar, you know. So for me, like a time like this when the market, especially tech stocks, are coming out of a big sell-off, I'm looking at things like the next big thing page, our IPO page, looking for ideas that are yet to emerge. So say a period like our current period, not a lot of IPOs coming to market. The ones that will come to market will probably get priced at pretty disappointing levels. You know, I mean, say an IPO that might have priced at 26 months ago may now price at 16 or 15 or 14. And, you know, I'm looking for those types of names that you don't have a crowd behind. There's some type of emerging technology, really strong growth that can potentially generate returns of 200, 300, 400%. You know, so I want to be early in a name like that because over the course of a year or 2 years, I mean, that could be a $50,000, $100,000 trade. And so instead of me scalping Xilinx or whatever, trying to make 500 here, 1,000 there, or 1,500 there, like I'd rather have that trade that plays out over an extended period that allows me to build size in and just sit back and ride. And, you know, sometimes with these types of names, they get on the radar really quickly. They'll report earnings and just blow out the numbers. Stock's up 30% that day. It runs another, you know, 20, 30% over the next several weeks, and it's just off to the races. So I just kind of wanted to highlight the differences in styles. And, you know, that's one of the reasons I really like our product is because we have guys doing so many different things. And, you know, whether it's short-term, whether it's, you know, futures, equities, IPOs, just, you know, the whole multitude of strategies. And I mean, I like to sit back and just see what everyone's doing. Everyone's generating ideas that I might be able to use in my personal trading or strategies. And you know, I think it's really compelling. You know, if we were just sitting here, everyone just day trading, I mean, yeah, I mean, it's just not, that's not a reality anymore. That, you know, there was a point in time that you could generate riches sitting there day trading all day. You know, that opportunity is long gone. You really have to have the discipline and the ability to recognize different opportunities. And, you know, one thing that I think that people often overlook is, and I probably started doing this maybe 10 years ago, is cash management. You know, so you may have cash sitting in your trading account generating, you know, really no interest at all. You know, think about ways to manage that cash. You know, for me, I've taken to buying preferreds as my cash management tool. So, I mean, understanding preferreds and feeling comfortable buying things that are yielding 7 to 10%, that's 7 to 10% that I'm generating on my cash that, otherwise I might be getting 0.02% or worse, and so just little things like that where you're looking at kind of a holistic view of your portfolio and your overall returns. You really have to start to pay attention to the details, and it took me probably 10 years to get to that point, but I tell you, trading has gotten a lot easier for me over the past 10 years by understanding the different moving parts and being able to take the time to really know what I'm doing. And so I'll just give you another example. So there was a point in time when I was kind of your typical technical kind of momentum trader, right? If something's going up, I wanted to own it. If it was going down, I didn't want to own it. And now I am able to take advantage of that. The fact that so many people, especially the short-term momentum traders, the smaller traders, are focused on short-term price action. Hey, I want to be involved. I need that confirmation that everyone likes this. It's going up. I want to be involved. But as soon as it starts to go down, everyone, jumps ship. And for me, that ability to analyze, do fundamental analysis of a name, and take advantage of when, say, a name breaks a key technical level and everyone gets flushed out and it falls 30% over a 2 or 3 or 4 week period. If I've done the work on that on the front end, I don't mind sitting there buying that, thinking, okay, I'm buying this for a 6-month period or a 12-month period, and over time, this could be a 100% runner for me, or 200-300%, especially if it has like some type of dividend associated with it. You give me something with a 25% coupon and a turnaround story, I mean, I'll take that all day, because I know that 25% coupon, even in, kind of a worst case scenario, if they can turn the business around, that'll get bid to probably a 10 to 12% yield. And so that's the opportunity to double, triple your money and also still generate 25% on an ongoing basis for possibly years and years and years and years to come.
Now, Scalp, you're no stranger, though, to making day trades, and some of the ones that you look at just off the top of my head, like Roku. What's so appealing about a stock like Roku and names like that?
Well, I like, so Roku is a name that I owned from the IPO and did really well on. This Canada Goose is a name that I owned from, I think I bought it at 17 initially. Did really well on. Didn't participate all the way in the ride up to 70, but again, it was one of those early names that wasn't on the radar, but they had a couple good earnings reports. People didn't really understand the story. I mean, Goose went from 17 to 70. Roku went from, it was under 20, I think, when I first got involved. Let's see where it went from. Pulling up the weekly here.
It's breaking out today, Damon. It's up 275 right now.
Yeah, I see that.
Yeah, it was actually on the TA page scan. So just so you don't completely poo-poo technical analysis on me, Roku was on 2 different scans here, on the Doji setup for the daily and the weekly Doji inside week setup. So nice bullish breakout going on here today.
Yeah, no, I think technical analysis is great. I'm just really emphasizing the different styles and the different time frames, and the point of, we have different strategies going here, and for someone like me, I understand that a lot of people are focused on technical analysis, and that creates opportunity for me, because a name may break a key level and everyone scampers. Maybe you were out of it well before it broke that key level, or wasn't on your radar. It's not something you were involved in at all. But say something may break a key level at 35 and then tumble down to 25 over a period of time, and no one wants to touch it until it gets back to 32 or 33. Whereas I may be buying it, down at 25 or 26.
I hear you.
All right. So I think it's safe to assume, though, Damon, you recycle a lot of your names that you day trade, like Roku, Goose. So names that you are very comfortable with, and then you're very used to the type of price action. So therefore, you can get an edge on when you do see something that may break down. Case in point, Goose.
Yeah, I mean, so Goose is a name I haven't traded in quite some time, and so this is more kind of a sentiment slash fundamentals trade. I know that, I mean, this is a name that's pulled back pretty substantially off its recent highs. You get a broker downgrade. The broker downgrade looks a bit late. You know, you can tell they're kind of waiting until the holiday season ended, get past that period, and come out with the downgrade. The stock is already priced in to some degree some disappointing results, and you know, it's a quality name. It wouldn't surprise me to see institutions down here buying a name like this when it's on sale 10% intraday after already pulling back a third from its recent highs. So yeah, so I mean, you know, if I understand the kind of fundamentals and the sentiment of a name, I'm willing to consistently trade it because I have a feel for the price action, as well as, you know, always like to know where institutions might step in or understand the names that institutions might have an interest in on a pullback. And so you get that thin name that's down big that somebody's been waiting to buy, that maybe they missed out on the first run up. You know, I like names like that. I like the ability to participate in a situation where maybe an institution is helping to step in there and put in a bottom.
All right. Is there anybody else who wants to chime in on Goose? I know a lot of you guys have traded this one, Event Trader, and you have too, Blue Chip. Do you like it at these levels?
I like Damon's trade here for sure. It's like, I agree with him. Like, this is coming, this broker downgrade seems a little late to the party. Stock corrected 40% in December. It's recovered about 22% of that in the last 4 weeks or so. It was up against some resistance earlier in the week, right around that $50 mark with the 200-day moving averages and the 50-day EMA. So, I don't know. The downgrade, like I said, it is what it is, but down 10% on a downgrade, and he's at levels right here going into midday where he's probably got a good chance of, timing-wise, I think that was just an ideal entry point for him to get involved here as the momentum typically slows down around lunchtime in the market. So I think it was a well-timed entry for sure. Yeah, if the stock can easily come, you know, back a buck and a half to those initial first hour ranges around $46 at some point this afternoon or midday. So that's a nice intraday trade if that plays out.
All right, so as we speak, we've got the market trading closer to the session lows. So what's the overall takeaway? Are we going to continue to see a breakdown? Is it going to remain choppy?
I'm expecting to see a continued breakdown here myself. This is a big level for the S&P. I think we had 2630 as the pivot. So, you know, it's just, I think we're just caught in two ranges where we're going to roll over around 2650. We're going to see some buying at 2600. I mean, that's kind of how I'm looking at things right now. I don't know what's going to entice people off the sidelines to buy here into the close. Certainly, we're going to have some headlines coming out from the vote on ending the government shutdown, and we're just kind of at a point where there's not anybody tied to ideas in these levels, so you could see them getting shaken out a little bit quicker. So I'm thinking that we'll just kind of see some further to the downside, and then anybody that's looking to come in and buy this dip, you know, we could see them pop in towards the end of the day.
Yeah, let me follow up and say that earlier when we talked, I noted that because we shook out the downside and then popped back in the middle of the range, a subsequent move back through that downside would be far more important in that proof-disproof sequence. So I would agree with Gavin. I think it's possible that rejecting this bounce and moving back down through the levels that we defended before one more time could lead to a significantly increased chance of follow-through on the downside if we do it.
A key aspect to it too, Brett, I think is the SMH, whether or not this could hold these gains around 95 or we see that roll over.
I would agree with that.
All right. Well, I'll say this much as far as where we're trading at so far. It's seen a little bit of support throughout the day at that 2630 level. Breakdown through there, in my opinion, is troublesome and probably gets a test going to the 26 even level. So for what it's worth, I do think the 2630 level is a big key inflection point.
Yeah, I'd like to make a comment. Would everyone be able to go around and provide maybe the one or two kind of key ideas or points that you feel help you in terms of maybe lessons learned over the years that you think are important to convey? Because one of the things that I recognize is that trading is a game for those who are constantly evolving, and the people who can't evolve, they don't tend to continue. They're usually not able to kind of stay with it because they're focused on this one strategy, and they can't make the adjustment to new opportunities. And so I know all of us have, over the years, have evolved quite a bit. So I just wanted everyone to kind of jump in there and throw out some key points that they think people should be aware of in terms of life-changing trading or investing tips.
Did I go first?
Yeah, go ahead, Chuck.
All right. I got one. I thought about it earlier today, and I realized this is one of the most important things that I do because somebody asked me through an email how I've managed to do what they've watched me do over the last several months, and so really increasing my aggressiveness and having a high hit rate during the really high VIX period in December, and then slowing down now but keeping kind of a good leash on things and not over trading. And it was somebody who suggested that they were taking some of their own trades and didn't want to press it too much without my advice because they were still learning. And how is it that I waited all day, for instance, before taking that one NASDAQ trade rather than all the other setups that look similar to them? And I would say the one thing that occurred to me that I feel like is really important in all of those things and stringing them together is people try to trade, and I would suggest that you just reverse the psychology on that. Try not to trade. It's about kind of the threshold for taking action. I come into each day, and I kind of try not to trade, and it puts me in a mindset where the market has to offer me up something that's so compelling that I can't stop myself. And I just trust the fact that my intuitive judgment is going to be correct. When I feel that way about the situation, I know what's going to happen. It's like watching a rerun when it comes on TV, like an old Seinfeld episode, and you're trying to figure out whether or not you saw that episode, and then George says something like, "Oh, I remember this one." I look for that feeling in the market, but I've seen this a million times before. I know what's about to happen. And when you come into the day and you're sitting there going, I'm trying to trade. I'm looking for a setup that's going to help me. I'm looking at this. I'm looking at that. Is this a setup? Is that a setup? What's a setup look like? I want to find a setup. That mentality will lead you into a million different little cuts. But if you go into the day saying, I want to see this market, I want to let it tell me what to do, and I want to not trade until I can't stop myself because the situation is so ripe that it's going to fall from the tree right into my lap. So I think just reversing that psychology and trying to avoid trading unless it's just compelling. It's just dead on the money. It's something you intuitively have a strong sense about, and then putting on that trade rather than taking shots here and there all over the place. So I would say if I go back and I trace my personal history, when I became much more sustainably successful, and I stopped resetting my account by having big up periods and big down periods, when it just started to kind of work, and it just kept working, is the point when I really got around that corner and I came into each day kind of trying not to trade unless the market really gave me just exactly something that I felt a tremendous amount of conviction about. So that's a principle that definitely I would put right kind of at the center.
Hey, Brad, would you equate it to like breaking a bad habit, where it's almost like addictive, right? Like the ability to come in and look at the market and not trade. I've experienced that personally, and I think my first step to recovery was starting to take Fridays off, realizing that Fridays were not the ideal day for trading, and so if I didn't have something compelling within the first, say, 30 to 60 minutes of the session, just closing down for the rest of the day. And that was hard. It was hard to sit there and look at a screen and not do anything. And it probably took me a couple years to get to the point where I wasn't pulled in by the action, by the price action. So.
I know exactly what you mean, and I'll say this: I've gone through that same process, and it gets better. Just like you'd say to an addict, right? It gets better. Like, you stop feeling that way over time when you pattern your behavior, when you start to realize the benefits, the advantages of coming in with that different mindset. You stop feeling that sense of that adrenaline rush when the bell rings in the morning, and you start just feeling almost a different kind of adrenaline rush, which is just being psyched about your success. When you stop getting sucked into this process of having to trade every moment, no matter what's happening, and you start getting excited about being choosy, being selective, coming up with a plan, staying disciplined, and then executing it, and watching it happen over several weeks or over several months. That starts to become the exciting thing, and I think that shift about which of those two things is exciting is the shift that makes you a more sustainably successful trader.
Yeah, definitely, I would agree. Who wants to jump in next?
I'll go. So for me, I think the key thing is position sizing. Obviously, like these guys just said, it's to come in every day and see just a plethora of opportunities to just jump on board as soon as the market opens. Heck, you can even trade pre-market. You really kind of have to have that discipline to just kind of wait for what looks best for you. So when I say position sizing, I guess that kind of falls into the whole do what's most comfortable for you. You never want to put yourself into a situation where you're uncomfortable with a trade. And I've joked about this in the past. A simple test is if you find yourself within, say, less than a foot of your computer screen, and that you haven't gotten up to take a bathroom break in about 3 hours, you're probably doing it wrong. You're probably doing trading completely wrong. You really should not have that kind of intensity unless you're like a market maker. And now I think about it, even the market makers and the specialists, they had backups, so they can always step away from the market when they had to go clear their head a little bit. But if you're following this stuff and you're super close to your monitors and you're watching every single little tick that's going on there's a good chance that your position size that you put on is making you uncomfortable. And I've said this before, you have to earn the right to trade larger size, meaning you have to actually build up your account. So obviously everyone starts off with a different amount of capital to trade, but in the way it works in like a prop shop or even at an institution, they're not going to give you more capital until you've actually made money for the firm. And you really need to handle your money the same exact way. And my recommendation is, if you are struggling or if you are uncomfortable or you're not consistently profitable, you need to cut back on your position size and the amount of trades that you take. And then over time, you're going to realize that by reducing your risk exposure, you're going to be a little bit more clear-headed, and you're going to be giving the stocks and price action the wiggle room that they need on an intraday basis, that you're not getting stopped out all the time. And you're going to all of a sudden realize that you're managing your risk automatically, and the profits should just kind of flow naturally. It should come second nature because you have your risk and your comfort zones under control. And then after a couple months, and however long it takes, when you reach that next benchmark that you set for yourself, say it's 20% of your capital, then you ever so slightly increase your position size. You don't go and double it or take on excessive risk at any point in time. It's about just being comfortable with the size that you're taking and focusing on risk management first. And that to me was the real turning point overall even in my own analysis and trading. Once I stopped focusing on I need to make X amount of money today, and I need to make that money back that I lost, and I need to make this money, and just shifted my focus away from how much money I need to make or going to make on a trade, and then just putting it more into a perspective of, hey, I want to put this trade on, and I have the ability to walk away from my screen, knowing that it's still that I don't have to worry about it. That anything, my system can crash on me, and I'm still going to be okay. I'm not going to go completely nutso. And that's, to me, that was the real turning point for being consistently profitable in my trading over the years.
All right, Ben Trader here. For me, the two things that I've definitely tried to kind of adhere more to is, one, not getting married to an idea, meaning that sometimes you could have pretty strong convictions and you continue to keep going to the well and just losing out on the trade, or you start taking a beating in a name in a position that you're trying to build in. You can always average down, but at some point, you have to kind of manage it and manage the risk aspect of it, kind of like what Scott was talking about in terms of you never want to have a position large enough that you're not able to sleep at night. It's keeping you awake. It's just not healthy. And chances are, if you're that concerned about it, that in your gut that there's probably a good chance that you're wrong. So, and just managing that. And Telesat, the ticker symbol I, is one that I've been following. That I really like the setup for it, and I really like the name, but the stock action just keeps going against me. So it's one that at some point I have to figure out whether or not I'm going to continue to hold this position. And sometimes it's tough to cut it loose. Sometimes you're worried that you're going to cut it loose and then it's going to reverse higher right after you do that. And that's happened before, but there really has to come a time where you just have to accept that perhaps you're wrong on a position, and you go ahead and you take your losses and move on to something that you can find a little bit more profits in. So that would be one thing I would certainly say in terms of just being ready to admit you're wrong and moving on to another area where you could be a little bit more profitable in and have a little bit more success in. The other item that I would say is, and you've heard it from pretty much all the traders here, is making sure to manage that risk. So, having a set loss that you're ready to take, and when it hits that, you walk away from the trade, because as Brett said before with the falsifiability, that's where you should be setting that stop. That's where you should be throwing in your risk tolerance for, okay, if it hits this level, then chances are I'm wrong in my opinion on this and what I think the stock action should be. So I think when you can manage the downside of your trades better, then that allows you to kind of really free your mind and be able to hit some more profitable trades and to really manage your portfolio as a whole a little bit better.
Yeah, just to jump in, I just want to build on that quick. So particularly when you're watching the site and you see each trader go out there, and we say what we've always put our risk parameters after our entry points. Now, obviously, by the time people read the comments and they look at their charts or they look at their screens, the price action is going to move a little bit. So there's sometimes that slippage that goes on. So sometimes it is possible, particularly when trading like futures or fast-moving momentum names, that the ideal entry point might not be there, and you're going to have to adjust the risk that we put, parameters that we put on the site for ourselves as for your own account. But generally speaking, don't ignore those the risk parameters that we put in play, because usually those are usually predetermined based upon not just the maximum amount that we're willing to lose, but it's also probably a point where intraday or daily on the chart, that if that was triggered, it would be a change and a shift in the pattern and dynamics. So for example, Scalp went long goose, but he had $1.50 point, $1.50 risk parameter on it. So getting long somewhere in that mid 44s, you had to basically be willing to put your stop loss down near 43, which I think was plenty of wiggle room for a stock that was down 10% or so. And you had to be willing to accept the fact that even if it did break down and go through 44 and trigger some of those stops at a key round psychological level, that it might slip to, say, 43.75, 43.60. But then still look okay for that upside potential that it had based upon the bigger picture. So again, you kind of have to really focus on risk and what it means to you. If you focus on risk first, I would almost guarantee you that the reward is just going to play itself out for you.
Okay, so I want to add one more to this theme. I think it's a really great theme. Actually, I think that everything that we've just said over the last few minutes since Scalp Trader initially introduced the idea of this, what's the one lesson that you would really want to express to somebody, I think this is probably the most valuable part of this roundtable. I think that if you just do the things that we've talked about over this period, you will see a dramatic increase in your success. But one final point that I wanted to bring up, so we've talked about keeping your size in place, and we've talked about staying patient and selective. We've talked about not getting married to something that isn't working. We've talked about kind of all of those basic issues in ways that are really kind of practical in our experience and how there's real deep meaning behind them. But there's one other issue that I would say deserves to be in that front and center, and I don't think that it's very often expressed, and it's something that I've kind of gelled around as a really important psychological variable, and that is not worrying about missed opportunities. And there's a very, very particular reason. Worrying about missed opportunities, when you believe that something's going to happen, when you've been looking for something, and it happens and you're not in it, people tend to beat themselves up. They're like, oh, God, I can't believe I missed this. I totally thought the market was going to do that, and I'm not in it. I made nothing on it, even though I was totally right. And there's this process that people feel inclined to do, especially socially. Like if you work on a trading floor and you've got colleagues that, like, you beat yourself up in front of everybody. It's like people feel like they need to just beat themselves up publicly.
Hey, Brett, real world experience, this S&P is breaking down right now for what it's worth.
Yeah, I know, right. So that's exactly why I thought of it. I was like, we both just sat here and said the market was going to break down, and we're not in it. But here's what I want to pass on, because this is one of the most important things that I've learned over the last couple decades of trading, and I've gone through bad and good versions of this and realized where the truth is. And the truth is that if you beat yourself up in those situations, you will end up creating a negative psychological experience for yourself that is very much tied to this type of experience. And there's huge consequences to that. When you start to, it's just sort of Pavlovian, when you start to attach negative emotions to missed opportunities like that, it will, I promise you, it will result in you chasing bad setups in the future. You will end up wanting to avoid that psychological experience. So you'll be right on that line of not knowing whether or not it's going to create that experience. You're not sure that you think the market's going to break down, but just in case, you end up shorting the market even though you're not sure, because you really want to avoid having the psychological experience that the market then breaks down and you look back and you said, yeah, I kind of knew that was going to happen, and now I feel like crap, because there it goes. And it's really important, and the one way around that is you just state plainly, lots of stuff is going to happen in the markets. The market's going to go up, it's going to go down, there's all sorts of stuff going on. It's always going to be happening. Another bus is going to come around. Focus on understanding and defining the setups that you're interested in. Execute on those setups, and if it's not exactly perfect and you don't get in, that's great. Great job. It doesn't matter when it actually happens. It doesn't matter whether the market goes toward your bias or not. What matters is that you're executing on the exact specifics of your setup. So if you get something that doesn't feel quite right, but you're sure the market's going to go lower, but you don't get, like, for instance, this is a great situation. I was going to short the market if we had gotten a little bit more of a bounce. Now, I kind of knew there was a good chance I wasn't going to get that set up because we had already established that low. There's going to be lots of stops down there. There's a decent chance the market's just going to Drano right through it. So you may not get that situation where you get that little bit of a bounce like I got earlier, and you're able to set your risk and your stop in a place where the ratio to possible rewards makes a lot of sense, as like a 3-to-1 or something. I wanted that type of setup. I thought there was a pretty decent chance I wasn't going to get it. But that's okay, because this is not my first rodeo. I know that I want to see what I want to see, and if I don't get it, I've got no problem not being in that position, even if the market does what I thought it would do. And that's because I've learned that lesson, and it's a really important lesson to be able to let the market do what it's going to do and not feel like you've got to be in every position that is working toward your bias. So another couple examples, we're back in December, early December. I said we were going to break the November lows, we were going to break down really hard, and right after the Fed came out, I posted a note on the page saying this looks like the market could really get crushed because of what Powell just said, and the market did get crushed, and I wasn't short, and I got all sorts of stuff on feedback about how could you not be short, you knew the market was going to go down, and it's because I didn't get the setup I wanted. But later that day, I did get the setup I wanted. I put the trade on, and it worked really well. And it was because it was set up in the way that I wanted to take it, and I wasn't worried about missing out on the move down. So the big takeaway is, another good rule that will help you in the future is don't beat yourself up on missed opportunities just because your bias on the market is right. If you don't get a setup you like, that's fine. Let it go without you. It's okay. If you beat yourself up, you're going to end up making poor trades in the future to try to avoid that same experience.
All right, and I would echo that, Brett. That's probably one of the biggest things that I've had to get over is that fear of missing out and just being patient. And it's certainly helped me over the years survive this this minefield that can be the market. Does anybody have any parting shots that they'd like to just leave our listeners with? Maybe a trading idea, or just something else from a philosophical standpoint that they'd like to leave?
I guess I just want to point out, we'll talk about this a little bit later, is we talked a lot about the SMH today. Intel's 13% of the SMH, and they're going to be out reporting later. So that's going to be a key item that I continue to keep an eye out on, so just wanted to toss that out.
All right, and I know Scalp Trader, you already took some profit on that Goose trade, Goos.
Yes, I just wanted to lock in a piece just to get something off the table. Again, idea is to try to make a little money, and even if it comes back, we still made some money. I like to see another point and a half out of the remainder, but we'll see how it plays out. And in terms of a parting shot, I guess one thing that I would add is, over the past, I'd say 6 or 7 years, I've noticed that I've made most of my money over probably, I'd say 80% of my gains over a 2 or 3 month window of the 12-month period. So that's me. I think Chart's probably in the same boat.
Absolutely.
You get periods of opportunity that are just compelling, and then you get periods like this very moment in time, like the past several days, that are just terrible. I mean, we've had such a magnificent run off of that December 24th low that, to me, the thing that I've been reminding myself of is, okay, you did really well for those two weeks. You pretty much made my year. It's really important not to give those gains back right now, because a lot of times you'll have a real period of success. You'll get extremely overconfident, and in my early days, I would continue trading right now, just looking, hey, everything I did so well 2 weeks ago. Why should the party stop? Let me just not keep trading until I make $10 million or something. But the reality is that the music does stop for periods of time, and so it's really important to recognize when the music is not playing and to take a step back and just wait for for things to fall in place again.
Hey, just to build on that, Damon. So I can I understand that you and Scalp do really, really well during periods of high volatility. You and Chart, I'm sorry, you do really well during volatility. When the markets start collapsing through back in October and the VIX was jumping over 20, that is when, for me as a swing trader, I started to struggle a little bit more. I was getting stopped out of the positions that I was holding in context of trends for a couple days and weeks, and I was seeing this shift in the markets, and I started throwing out more hedges on the short side to compensate for the lost profits that were happening. And then it took me probably until about Thanksgiving or right around mid-November where I had the VIX was consistently high above 20 that I said, you know, I need to start changing my gears here a little bit. I started cutting back on share size. I started trading a lot less, just because it wasn't the environment that I had succeeded in the entire months prior to October. And that's when you and Chart Trader really stepped up your games, and you started actively getting involved and just killing it left and right on our sites for those particular type of trades. So whereas I agree with you guys wholeheartedly, where a few times of the year, you know, there's going to be just months or periods where you're just making, it just feels like you're printing absolute money left hand over fist and nothing's going wrong. But for me, it was almost opposite. Once the VIX started spiking higher and everything started getting wide and loose in trading, even when I cut back my share size, it just felt like I could, everything was 50-50 for me. I'd make money and I'd lose money. I'd make money, I'd lose money. I'd make money, I'd lose money. And then it really didn't start coming together for me until probably right before Christmas during the holidays, and everything started turning around again. So, but again, I think the key thing is you have to recognize those conditions. The market's not in this it's constantly in this changing state, and what we're trying to do here on the site is always make everyone aware of the current market conditions so they can assess, bring it into their own analysis, and, you know, determine their own risk parameters and determine which vehicles work best for them, which approach works best for them during that time frame.
All right, Brett, and I have one more for you, if you don't mind, and that is, yeah, that's your overall takeaway here in crude oil. We had a big build, one of the biggest builds I can recall, but here we are, we're up 63 cents, more than 1% here, trading above the 53 area. What's your sense on this crude market?
Yeah, I mean, it's pretty interesting to see. I mean, it was a huge build, totally unexpected. So, yeah, I think that it's, you know, you've got to look at how that kind of goes against the logic that you think with short-term traders. So obviously there's something that was absorbing all the shorting, because I'm sure the shorting happened off the data. So that, you know, you kind of look at the background, right? The ground, not the object in art terms. And obviously there's something that is highlighted by that, and that's a big bid sitting underneath this market because it just absorbed all of whatever was in reaction to that data. And I'm sure there was a lot of shorting coming in on it, and it just held. So, and at the same time, I don't know if you remember our crack spread conversation. The crack spread's broken down again hard. So, I mean, there's going to be less demand coming from refiners at the same time. So it's just it's a very interesting sign of strong support in this general region. Obviously, at some point, we're going to have some kind of pullback, but I would say 50 is looking more and more like a relatively reliable level for the time being. And I guess it's kind of, as I said earlier about the financials, the sense of like, well, it was a washed out area of the market because people were really looking for the possibility that we were imminently moving into some kind of recessionary situation, and the type of data that we're seeing, at least out of the U.S., doesn't suggest that. So crude oil has some ground to make up just in terms of flipping that bias. But yeah, I agree with you. It was a really interesting tape there.
All right. Well, it's definitely something that you and I will follow up on in the coming sessions to see if there's any opportunity in crude oil. I know you're no stranger to trading that. Neither is a commodity trader. We didn't get him on, but maybe we can fit him in on one of these roundtable discussions that we'll have coming up. Gentlemen, let's do this again soon.
Yeah, no, this is fun. Anytime.
All right. Well, I'm hoping to get you guys all on next week, and we'll come up with some potential new trading ideas. And as always, gentlemen, thank you so much for joining us. I'm sure the listeners definitely appreciate your time.
Thanks, Jim.
No problem at all, Jim. Talk to you soon.
All right.